Welcome back, viewers. Today, we're going to talk about three things: sector updates. As usual, we'll cover how the sectors are performing, asset allocation. This is something which I've been getting from friends circle, that how to allocate our portfolio, kind of a breakdown of how what types of stocks to invest in, and how do you break down your portfolio into three different sections, and then our regular monthly updates on few stocks based on the sector performance. So those are the three things we're going to cover. Let's start with the sectors. Sectors, I've picked up the last quarter performance. If you look at it, some of the long-time laggers have become leaders now compared to the most recent leaders, which are like information technology, finance, and consumer discretionaries. Those three have become kind of laggers, and long-time laggers have become leaders. For example, material, where all the gold, rare earth material, chemical, as well as gold, silver, copper, are all coming under materials. They have been very volatile in the market right now, but people are moving all their investments or funds into these material sector. We've been seeing a big leaders there, very volatile, could fall any point of time. It could fall 10-15%, and then come back again 10-15%. So people are finding opportunities, especially pullback opportunities, and then they are investing money in it. Material seems to be performing well. Again, it depends on how the emerging market is reacting to current tariff situation, as well as some of the weakness in the dollar, as well as U.S. sector or U.S. stock market equities performance. So they're kind of diversifying their funds, or kind of pushing their funds into the material sector. Gold, silver are the leaders right now. Everybody's investing in, which is good for some of these emerging market, because they are consumers of these gold and silver. So they have enough stockpile for that, and they are taking advantage of the current situation, market situation, and probably pumping in some of these materials into the market right now. Followed by the energy. Energy is one thing. If you look at it, data centers are growing everywhere. There is a high demand of energy. You could see some of those energy sectors, energy leaders are performing well right now, because there's a huge demand in the data centers. People wanted these grids to be very active, so that way they can generate power, and use that power to power in all the data centers, which seems to be the direction the market is going right now. All the energy companies are doing very well right now. Followed by the consumer staple. Consumer staple is day to day things like Coke, Pepsi, Walmart, Target. All these things fall under consumer staples. So people are taking a safer route, where they're saying, "Hey, these companies, no matter what the economy right now, but consumers basically go for these standard companies where a regular demand is there. You may not see a growth, but at least they won't lose money right now. It's kind of an edging strategy right now. So people have moved funds into consumer stable companies. So that's where the sectors are right now. These are the top three performing sectors. Let's start with the
And these are
sectors
the
first.
laggard.
Sectors, traditionally, majority of the time, IT sectors have been performing well. But now the market conditions are slightly different, and I've been looking at past 3 months, last quarter's results. Some of the sectors leaders were now called laggers, and some of the laggers became leaders right now. For example, material, energy, consumer staple. Consumer staple is a stable one. They're not laggers, they're not leaders. They kind of keep it in the middle. But material, energy, or they're long-term laggers. Now they've become leaders in the market right now. All the copper, gold, silver companies have been performing well. At the same time, rare earth material is one which has a high demand right now. Uh, Companies are consuming these rare earth materials and chemicals to power in some of these EV sectors and companies. So that is one thing which is performing very well. Followed by the energy. Energy, if you've seen, we have data centers coming up everywhere, all over the world, and energy demand is going up. Some of these energy companies are performing well, because basic demand of these data centers is to get the power. So these energy companies are powering these data centers, and they're not small data centers. They are massive data centers, consume high power. So target some of these power companies which are generating these power to the data centers, and that's what we're seeing right now. The leaders are the energy sector. So some of these power companies fall under energy sector. Followed by the consumer staples. Consumer staple is kind of an edge in the market right now, because if the other IT sector, financial sectors are not performing well, people tend to move their money into companies where it's a stable income, a stable demand is there. For example, some of the examples of consumer staples are Pepsi, Coke, Walmart, Target. These are all consumer staple companies, so, kind of industries and sectors. So they give you a standard flow of money. It's this is a strategy, edging strategy right now in the market, because other two sectors, the top sectors like material and energy, are very volatile right now. So people tend to move their funds into consumer, where it has a stable demand, where their money is growing rather than being in the lagger sectors. So that's what we are seeing right now. Uh, this is kind of how the past 3 months played out in
I
the
want to
sector.
compare the past 2 weeks of data, especially how the sectors are transforming. I did the video for the previous video was for Feb 12th, and this one is for Feb 19th. You see the difference in how these sectors have performed. And you can see that the biggest winners are material, energy, industrial has come up, consumer has come up. It was last week, it was third, if you have seen my previous video. And then this week, it is down to fourth. So industrial has picked up. It has gone to 17% growth. Real estate, it's slowly coming up. It's the fifth sector in the list. You could see that the anticipation is growing here. There are things which people are expecting to happen before the summer holidays for kids. That's when all the real estate business boom comes into play. And the next is the utility stuff. But the pattern is pretty standard for IT, information technology. You could see that the percentage is pretty low compared to last week, 3 months data. It was somewhere around 5%, negative 5% now, kind of bounce back. So there are good. There's a good performance in a week's time frame. Some of the positive messages coming in. Tariff war. Uh, so Supreme Court has actually went against the tariff implementation. So we don't know how things are going to shape up down the line. Whether this country has to return the money back to all the other countries who have paid the tariff. We don't know what happens to the consumer who have paid this additional cost, because all these businesses have actually kind of trickle down that tariff thing to the individual consumers. Are we going to get the money from the businesses? We don't know. If you went to a restaurant, a couple months back, it was $100. Because of tariff, this month it is $130. The $30 difference is hit to us. Are they going to pay back that money? We don't know. So there's so many things going behind the scenes. So we don't we're not 100% sure how it's going to turn out. But overall, looking at the sector, the pretty standard ones are the top two: material and energy. Consumer staple is another one, which is kind of in the third. It was in the third. Now it has come down to fourth. So watch out for these three sectors where you have a potential growth, potential opportunity to go invest and take some advantage of some of the dividends what these material and energy companies are paying you. So that's an edge for you. That's a quick rundown comparison between last week 3 months results versus this week's 3 months results. You see the difference. All the sectors are in the positive
One of the
direction.
common question which I get from my friend circle as well as from some of the audiences checking out my YouTube channel, or like, how do we allocate our funds? How do we structure our portfolio? That way, we are targeting the right companies. At the same time, we're also making our portfolio to grow in a steady pace rather than just ignoring it, leaving it idle. So that's a very common question. What I generally do is, I compare my portfolio to look at it how I structured my portfolio. This is something which I do it on a regular basis. So if you look at it, some of my portfolios, basically they're structured into three categories. One is the leaders, then I target the dividend, and then the third one is the anticipation, trending, momentum based stocks. So these are three buckets which I categorize my stocks right now. And I kind of relate some of these things with the respective stocks too. So how do you allocate? From percentage wise, you look at it, 50% is allocated to leaders. Who are the leaders? Every sector have leaders. Okay, for information technology, we have good leaders there. Microsoft, Amazon, Google, Apple, some of these things fall under that. Then when you go to the next level, power energy sector has their own leaders. We have consumer staples like Pepsi, Coca-Cola, Walmart, Target. We have leaders there. So every sector, find the top 2 to 3 leaders and invest money in it. Those are the leaders who will help you to grow your funds. That's how I look at it. Leaders. So leaders are a stable company, good fundamentals, good return on a yearly basis, and it helps you to grow your funds in your portfolio. That's leadership. Second thing is about dividends. Dividend is again is a category which I focus. Some of the portfolios don't have those preferences. They don't invest in dividends because dividend companies are pretty much stable. They grow very slow, but they give you income on a steady dividend income for you. Some of the investors or asset management companies don't prefer dividend as their strategy, and few heavily rely on dividend strategies. So different approaches, different models available. But in my portfolio, I focus 30% of stocks or dividend based stocks. I want to invest in companies where you have a steady flow of income, quarterly, monthly, whatever type of dividends the companies are providing. Just go for it. Look at the ETFs. Look at the energy sector ETF, consumer staple ETFs, and good performing ETFs. Vanguards are pretty good in dividend based stocks. So there are a lot of variety of a combination of stocks or leaders there for providing dividends. And third sector is the momentum sector, which I put 20% of my investment in my portfolio. Primarily looking at what's happening in the current market. For example, gold is one thing, material is one sector which have been performing very well, very volatile. So whenever you find that pullback opportunities, invest a little bit in that. Try to invest on a regular basis when you see opportunities. So gold is one, storage medium like SanDisk and Western Digital. These are some of the companies where their primary product is storage, and data centers. Data center companies are growing right now. And then some of the trendy companies like Tesla, EV related companies. So this is how I structure my portfolio. So look at your portfolio, analyze your stock list, bucket them, categorize them into these three buckets, and see where you're lagging. If you're lagging in dividends, find stocks which are paying you dividend. Find good stocks which are paying you dividend. Invest in it. And at the same time, look at what's happening in the trend. If you're not following the momentum right now, the trends, especially what's happening in the market right now, you're missing the opportunity to grow faster your portfolio. There is a certain level of risk is there, especially when you're chasing the trend, because it's very volatile. Things go really down south faster. So find the stocks, especially find the ETFs where you have a steady growth. At the same time, when there's volatile, you're not losing that much. So find those kind of stocks which are trending the right direction in the momentum right now. Take advantage of it. So look at your portfolio, break down or bucket your stocks into these three categories. Find the laggers where you're missing opportunity and go buy, target those
Let's look at
stocks.
the spider ETF. This is one regularly. If you have seen my previous videos, first thing which I look at it is the spider. Spider is where the actual measurement. It's kind of measuring tool for me to see where the market is. Market, if you have seen since November, it's only in the sideways churn. My previous video also called out. You could see that Darwis boxes or squares where the price movements are predicted, and when to enter and when to exit. So those are some of the patterns which I generally follow. So looking at this pattern, so since October, December, since January onwards, or probably since November onwards, things are always in the sideways. We did come out of this price point, which is 688, but again we are in a sideways movement. So it's the market is very cautiously moving up. That's what it means. Very tight. If you see some of those candlesticks, they're very tight, like a less than a point, less than a percentage growth every day, and then a less, half a percentage down on the following day. Right? It's very tight. The price movement is very tight. And you see the similar trend happening here too. It's only sideways movement, and I think the best buy point is that once it hits this mark 698 is when you could potentially get in. You could probably see another what do you say, another box here, rectangle box, which could basically say, yeah, you know what, this is what the next price movement is going to be. It's something like a step model we have. You could see that the price slowly going up, not this type of growth you're going to see for next for I'm predicting this as for 2026. This is how the market is going to behave. Very cautiously moving environment it is. So hopefully, there's nothing positive in the market right now. It is just moving for some reason. We don't know the reason behind that too. There's no indicators other than the AI movement. I think there are good players there in the AI space now. Things are getting, I would say, you can figure out who are the top companies who are going to play a major role in the AI growth. There are a few companies like Microsoft and other companies have taken a backseat. Hopefully, they will find some opportunities to come back again. For now, I think you see the good players there. I think the momentum is more on the AI side, consumption side. So hopefully, the companies, the data centers, the AI companies, data center companies, energy sector, followed by a volatile material sector is where all the money is right now. So that's where people are moving their money. So this is going to be the growth for this year. So hopefully we'll see some progress in these four sectors where the growth is, and then gradually the other sectors will follow this one. So from the S&P 500 kind of spider ETF standpoint, the growth is pretty stale right now. It's only in the sideways movement. Take advantage of this. Anything hits 676, enter. Anything hits here 69, so 676, 696, 20 points difference. So you exit 696. So you buy here, exit here, and it's going to be the trend for some time. And then once it crosses this point, 696 is when you can enter. That becomes the next box for you. So So that's going to be the model for investment going forward
So
for
looking
this
at
year
the
until we
moving
see
average
some. And the demand standpoint, it is, so the moving average is not properly aligned. You see the 50 days moving average, the price is below 50 days moving average. It is also kind of touching the 20 days moving average. 9 days moving average is, it's at the bottom, so it's actually reversely aligned. So ideal time to invest is that your 9 days should be higher than 20 days, 20 days should be higher than 50 days. So that's an environment, a positive environment for us to invest in. For example, at this point is as a classic environment to invest in, where you see the growth. But this one is in a reverse alignment, which means that the price is not appreciating there. At the same time, looking at the RSI is also very moderate demand. I don't see people are kind of, if you're looking at the RSI again, overbought, oversold, people are not fully invested in it. So they kind of moderate demand here. And it's going to kind of fluctuate between this 65, 70 to what do you say, 35 points. So within this range, and I think your more modulation or kind of variations here within between the 55 to 45 is what I see going to be for next quarter too.
The
So
first stock which we want to
that's how I
discuss
look
is
at.
about gold, the basic material. This is the most happening space right now. Both gold, silver, and all the precious metals were performing to the highest mark, which is very rare to see. Some of these materials and commodities are acting this way. Again, some of these things are coming due to confidence level in the dollar. It's going down, and people start invest in the commodities and materials. And gold is one of the safe haven for all the investors to invest money when the stock market, when the U.S. stock market is not doing up to the par. So that's what the trend is right now. Looking at the gold, I picked up one particular stock called as Van Wyck Gold Miners ETF. This ETF has a bunch of gold mining companies and gold sellers in this portfolio or in this holding. So looking at their past performance, quite a run they have since August 2025. It was kind of moderate growth, slow growth, very tight growth. If you look at it, some of those open and close as well as the daily price movement is very tight. But since August 2025, when things started moving south, especially with the stock market, things were slowing down. People started investing money in gold. I think that's where some of the significant growth happened. You can see since August we have grown at least close to 50 percentage, 50 to 60 percentage. You're looking at 60 percentage growth, and then there was a pullback, and then again another 60 percentage growth. So since August, since July 2025 till Jan 2026, you have grown your portfolio 120 percentage, so which is a significant growth. Gold has been performing very well, and then there's a volatility also is there in this space. The price movement, some of the gap up movement. If you look at some of those um, price increase, you could see that there's a gap up here, there's a gap up here, there's a gap up here, gap down here is a pullback. So it's very volatile right now. Market is, especially with the gold, you can see gap up here. So when you see gaps in the price movement, it is one of the indicator that it is very volatile. You don't know what's going to happen the next day. But if you're as an investor, what you can do is, if you want to stay in the race, take the opportunities whenever there is a pullback. You can see there's a gap down, you can see the pullback. You could probably, that's an opportunity for you to go put some money in it. If you look at the trend, there's only one gap down, and then there is a slight kind of movement, then another gap down. So try to accumulate stocks when there is gap down. Again, go with the momentum. If you see good news, good sentiment around gold, right now that's how the market is right now. Everybody is bullish in the basic materials. So wherever you see gap downs, which is basically pull downs or pullbacks, try to buy a small portion of a batch, and keep accumulating until you see the positive momentum coming back. You can see there is a sideways movement. This is a good opportunity for you to invest. Keep buying it, and then there's a gap up, and then you see a significant run. So close to 120% is a very significant run right now in the gold. But off late, gold has been very volatile. You could see there's an 18% drop, which is very common with the basic material. Silver has gone down even further. So gold is far better compared to the fluctuation standpoint. And it is coming back. You could see the price is getting the momentum back again. And the trend is that the 9 days moving average is slightly lesser than the 20 days moving average, and 50 days moving average. So the price is actually touching the 50 days moving average. I'm expecting the price should go down further, slightly go down, because the demand is very low right now. If you look at the demand, the points are demand points are, you're looking at somewhere from 35 to 65 is where the demand is. So you're currently, it's very moderate demand. So I'm expecting the price slowly should pull back. It is a trend we're seeing right now. There is a little bit of momentum in the market for US dollars, and I think that's what you're seeing it in basic material or gold and silver. That it is kind of a sideways movement right now. The good chance it could be that the new Fed chairman getting announced. Maybe people are optimistic that he might change some fundamentals in the market, which could bring back the US dollars. So those are some of the positive momentums they're expecting, anticipating that it's going to happen. So that's why gold is actually in the sideways movement, but you still see some kind of fluctuation. It will come back to its original position somewhere around 110, 100, kind of 110, 112 is where I see the moment it breaks out of 130 13, then it's going to move upward direction. The trend is going to be upward direction, so watch out for that. Gold is in a very good place right now, but it is very volatile. If you're a beginner, new to the stock market, or uh, kind of a little bit sensitive to some of these volatility, you can stay away from gold. But if you're a little bit experienced investor, and you know how to handle this volatility, find the pullback opportunities and invest a smaller batch rather than dumping a big amount in this one and then see your capital dropping down 15 to 20%. So this is a good stock, good ETF. A lot of good gold miners are there. So that's why I picked up this stock for first. The next stock we want to talk about is about home builders. Off late, we have been seeing some improvements in the home market for sure. The number of houses in the market are going down. Gradually, the home builders are also gaining momentum right now. Again, we're just starting off the year 2026. Your anticipation is that by summer, some of these home builders should show some good progress, kind of slow growth. Then summer should pick up the pace, and they could probably do well. I mean, we're hoping that the government is going to bring some changes in the regulations as well as some help to the home builders. That way, that whole sector will get back on track. So that's kind of the expectation from the current government right now. That's what the big time investors are also looking at. So thinking in that terms, I picked up few stocks, especially the home builders. One of them showed up is the Lennar Corporation, Lennar Home Builders, very common one across the country. So they are in the basic home construction business. Looking at their data, currently they are at the base level. They had a significant growth past few years, and that growth actually got stalled once the interest rates have gone up. People started, once home buying goes out of the affordability range, then basically the new home buyers would just pull back on these kind of scenarios, and that's what happened. And some of the home builders did struggle when they hit that when they hit that phase where there are no potential buyers. There are more stocks, more homes in stock, where people are not ready to buy. They were trying to give some level of discounts and offers, but still, long term commitment with a higher interest rate is actually a challenging thing for the homeowners. So that is what happened in the market, and the home builders have taken that hit. It was a significant growth. Looking at this particular share stock, they were hitting peak 187 something, and then there was a complete pullback, meltdown since September 2024 onwards. The whole home builders home market actually went down, crashing down, and gradually crashing. It's not significant crash. So it lost its momentum. Definitely, we could see that around 80 points loss, and then slowly the momentum is building up here. We have seen some improvement in August timeframe, August, September, October timeframe. There was a little bit push when there were few changes in the home, kind of especially the interest rates. A couple of interest rates cut actually helped this home builders to get the stock out. Sell those pending homes which have been there in the books for a very long time. So that actually helped. Now it's kind of sustaining right now. People are anticipating that there will be some level of another level of changes coming in the home market. So people are waiting for it, and it's a good opportunity for you to buy a little bit of a smaller batches of these stocks and keep it on hold. If you have seen my previous topics in this video, one of the area which I would like to invest is anticipation. Anticipation is one key thing to look at it. That's how market works. So we anticipate that the home builders will bounce back for summer, and we'll have the inventory ready, and then government will help something in some way or the other way to get these home builders up and running. So that's the expectation. That's what I'm seeing in the market. Some of the news and some of the big time investors are kind of looking at this home industry right now very closely. So considering all those data points, this is one stock which is very very common and widely very well known builder. The price points are also very good, kind of in the base level. They are performing the base level, so around 120, 121. Support kind of support is at 115. Resistance is around 129, 130. So if it breaks out 130, then the next stop should be somewhere around 140 something. The next following stop would be around 170 something. So we have enough time. We have a couple months now for summer, so gradually the price should just move up. Looking at the moving average too, it's perfectly aligned. You can see that the 9 days is greater than the 20 days. 20 days is greater than the 50 days. It's perfectly aligned, and I'm seeing the projection is towards upwards. So the moving average has been aligned. The demand is also there. It has not reached the peak, but you could see that looking at the peak level is somewhere around 70 points. It is close to that, so we should see a little bit of churn to the sideways, and then the demand should pick up again. So watch out for this particular company, Lennar. You can also look at some other companies like the Toll Brothers and DR Horton. They're good companies there. They're also significantly growing too, are kind of slowly growing right now, but anticipating that the things will turn around in the summertime period. So watch out for it. This is a good time to buy if you are interested. Kind of betting on some of this momentum, kind of summer momentum. This is the right time to invest in. So this is one stock which I would like to share. Looking at the resistance point, and so we're hoping that it will hit somewhere around 140 first stop. The next stop should be somewhere around 170 to 150 to 170 range. So that's what I'm seeing right now with the Lennar Corporation. I'm watching closely right now. The market is not so up to the mark. The It is in the sideways movement, so I'm watching this stock. I might invest, take some smaller positions as you
And
look at this
accumulate
particular
that.
stock. The another interesting part, which kind of I missed out highlighting, is that this home builders are also paying you dividend. If you are a dividend based investor, then they do give you close to 1.64, 1.65 percentage of dividend, and they gradually grow too. So this is another buy kind of indicator for you to favorable indicator for you to buy this stock. Even if they don't perform, at least you get a close to 2% dividend for your investment. So that's one thing to call. The next stock we want to talk about is a company called Dominion Energy Inc. They're primarily focused on providing energy for the high demand region in the country right now. Who are they? Basically, they are major US regulated utility headquartered in Richmond, Virginia. They primarily deal with electricity and natural gas. Uh, now energy is the biggest topic right now because of data centers. There's so many data centers are opening up, and there's a high demand for energy. All the energy companies are doing well, and especially electricity as well as natural gas, they are doing very well. And you could see that in the chart too. There was a significant growth, 27% growth, and then there is a even very good momentum past a few months. But we'll come back to the chart a little bit later. Their focus is on providing a reliable power for growing demand, especially right now. All the data centers are getting set up, and Virginia, the East Coast side, is a significant player right now, where there's a high demand of energy there because of biggest data centers are getting built in East Coast. Especially Virginia is becoming a big hub for data centers. So they want to have a more reliable power for growing demand. Where do they get the power? I think 40% of them, as per data, comes from nuclear energy. Remaining, they are kind of using the clean and renewable energy model, as well as for long term, they're looking at the offshore wind is also one of the item in their portfolio. So that is one thing which we look at it, how the company is growing. They're kind of growing in multiple ways. The major is on the nuclear side, and then they have some solar and renewable energy, and then now they have long-term strategy towards the offshore wind. Very sustainable company. Net zero goal is what they're targeting. Again, we don't know how these companies are going to generate energy. Um, there are chances that they might be net zero. They're targeting for net zero. It's going to be a long shot for them because of the current demand they are going through. Very community focused. Their heavy presence in the East Coast, especially West Virginia and all, Virginia, especially that state is. This company has been doing very well in that particular state. And then, looking at the chart, You could see that it has grown 27% since when, since April 2025. Last year April, when there was a tariff war happened, kind of tariff announcement happened, the entire market went down. Even the energy sector also had the same hit, and then it slowly picked it up once the tariff things get reset. So we have seen a good growth here, 27, slow tight growth past 6 7 months. And then past few months there's a good demand there, sentiment, positive sentiment across all the energy sector because of the data center announcements by all these big companies. All these announcements actually helped the energy sector to bounce back. So uh, the moment they came out of this breaking point, which is 62.29 or 62.63, that's where it's a good buy point for this particular company. So we had a good run right now till early Feb. Now it is in a downwards kind of pullback mode, where you can see that the 9 days moving average, 20 days, kind of in a downward trend. The price is currently hitting the 50 days moving average. So I'm hoping whenever it hits the 50 days moving average, there will be a momentum again back, kind of momentum swing. So we should see the price should go up again. So, and the demand is, looking at the demand, it again, it goes back to the demand. We're looking at the RSI, it is currently at the lowest demand level. So we should see a bounce back. You're looking at price points or demand points from anywhere from 35 to 70 is the range. So when it hits that 30 35 mark, it's a good buy point for us, where the demand is sustained. Then it should come back again. So we should see a slightly pull back until you hit that demand. And then once you start seeing more and more data centers announcements, and um, I don't know whether there will be more future announcements on the data center side, but once these data centers start setting up, people are, all these companies are constructing these buildings and infrastructure. Once those things are in place, then we should see a big boom in the energy sector again. So the growth wise, it's going to be slow, very tight growth, but very stable growth. That's what key for energy sector. It's been performing like this forever. Sometimes that slow and tight growth also not very attractive for investors who want to see big price increase or big growth kind of mindset. If they're looking for that type of growth, you may not see that type of growth in this energy sector. But off late, because of the positive sentiment in this energy sector, you do see some level of excitement here. You could see the price movement from 62 to 66, which is close to a 10% growth. And looking at since April, you're looking at 27 plus 10, you're looking at 37% growth, which is a good significant growth in the energy sector. This sector is very slow sector. We have not seen this type of growth, and because of the sentiment and all the data center projects going on right now, so energy demand is high. We should see this steady progress there. Addition to that, they also provide you close to 4% dividend, which is very good thing. If you're dividend based investor, you could invest in it, slowly accumulate shares in this company. You would see there will be a growth definitely hitting, coming back again. At the same time, you are edging because you are actually getting a dividend also in parallel to the price growth. So this is a very good company to look at it because of the demand, uh, especially